afternoon, good evening, investors, whatever that might be for you. Welcome to the Provident Wealth Advisors Fiscal Literacy Academy. This is a special message presentation on investing in individual stocks. You know, we have a lot of people come in, we look at portfolios and, you know, maybe they had a good feeling about Apple stock or Facebook stock and they don't know, should I diversify this stock or should I hold it? Should I buy individual stocks or should I invest in broad diversification? That's what this presentation is about. This is about you taking a few minutes of your time, sharpening the saw, and expanding your own fiscal literacy academy. So your own fiscal literacy. Thank you for joining the academy with this important message. When you're broadly diversified, that means that you might own in your portfolio as many as 40, 45, 46 different countries around the world, capital markets that have stock exchanges and that trade equities. And it also means that you could have literally thousands and thousands of holdings. It could be 18, 19, 21, 22 different asset categories, depending on how those are engineered and put together. This is just a visual or one example. One of the things that I want to know as a financial planner is what sort of rate of return does my client need to reach all of their financial goals? I think that's a great question to ask because do you want to take on risk that's greater than the rate of return that you would need to reach your financial goals? And we look at some of these different asset categories, and they've done very well over long periods of time in helping people reach their financial goals. Look at the really small micro-cap stocks over 12%. S&P 500, the largest companies in the world that are United States-based companies, those have averaged long-term, going back to 1927, of just over 10%. Small-cap value stocks are almost 15%. What's interesting about this is that there is no stock picking required, no market timing required, or no special track record investment that's required. It's just owning these asset categories where the returns are on the table for the taking for the investors. Small value over 14% and international almost 10% going back to 1970. I think one of the things that we're all exposed to are all of these come-ons and these advertisements. And they're on, you know, you watch a golf tournament or any sporting event, and you know these commercials just come on, and they say things to us like, "Get an app and trade like a pro," and hey, just you can be trading your money, and it looks appealing to many people. But I think this is also high stakes. I think there's a war for the investor's mind. You've got an investment community that says, "Get an app and start trading." And then you have investors that maybe they've tried that in the past. Maybe it's worked well. Maybe it hasn't worked so well. Maybe they've lost more money in the past than they imagined. And they're just trying to find out, what is the prudent path for me? Should I buy and sell and trade stocks? Or should I rather own a diversified portfolio? I believe the quality of our lives are determined by the quality of our decisions. So thank you again for taking a moment to examine some of the evidence in this presentation. You know, the Oracle himself, Warren Buffett, said, if you don't feel comfortable owning something for 10 years, then I wouldn't own it for 10 minutes. You hear us continually speak about investing have a strategy for the long haul. And I think we all acknowledge and respect Warren Buffett, he's not a day trader. He doesn't have a phone, hooked to his hip, and he's not reading Japanese candlestick patterns, and he's not put sells and all of these hedge collared book call spread strategies that they teach in these trading academies. He says you own great companies for the long haul, and most of us would consider him more than mildly successful in what he's accomplished. There's so much empirical data and evidence, empirical studies now, this one from the Journal of Economics and Portfolio Strategy, where they've taken long periods of time, and they've looked at many of these very active money managers, mutual fund managers, and incredibly, only a small percentage of them actually beat the market. And when they have done it, they've attributed that to luck rather than skill. You may have seen from the 90s through Markowitz or Burton Mackiel, some of these studies that said that these professional money managers and the $5,000 suit, $1,200 pair of crocodile shoes, that they're really, as far as picking stocks, not much better than a monkey throwing darts to pick their stocks. And the proof is in the pudding. We can look at something, what happens when investors are buying and selling, buying at the wrong time for the wrong reason. Typically, when after something's run up, we get calls at our office when stocks have run way up, when Amazon or any other stock, when it's at a really high point. Sometimes people will call and say, should I buy some of that stock? They never call when that stock is at a low water marker in a trough. And what they found is that investors are continually buying and selling and trading at the wrong times for the wrong reasons, making emotionally based decisions. Something like the S&P can have a long-term, this time period, long-term rate of return of 10 to 11%, but actual investors are taking equity risk, but only earning a small, maybe 3 or 4% on their returns because of their strategy or lack thereof, and or investment behavior that's generally going to be emotion driven. So without a formula, without a strategy, just buying and selling and trading stocks, investors are not able to capture these long-term rates of return. And I think that's really unfortunate, particularly when we look at the vast percentage of Americans that are nowhere close to being able to reach their financial goals. We need to earn good rates of return. We need solid investment performance to reach our financial goals. I would submit that all of our clients need to earn rates of return sufficient to reach their financial goals. And it makes me wonder why more people don't use a formula. So what do? Oftentimes people will go to the magazines and they'll go to the news and they'll turn on Kramer and see what he's squawking about on television. And this is just one example of Morgan Stanley's chief economist, Barton Biggs, where he admonished investors to get out of the United States with their money during this period of time. And he said, this is going back to 1993, I want to get, in the quote, far away from Bill and Hillary. He said the U.S. is going to be terrible. Well, actually, during the next 5 years, the U.S. was up 22.5% for a total return of 273%. If you just picked up the magazine and it sounded like a good argument, maybe you missed out on some really big returns that you should have had. Some of these magazines will go so far as to say, hey, here's some stock picks that will make you rich. This magazine, and I'm so thankful that our research team, I like to think the folks at Matson Money, Formula Folios, I'm so thankful for our research team that captures some of this information that's really out there that has led investors astray. And I'm going to show you what these 10 stocks actually did, that they said that these appear certain to transform the way we work and the way we invest. If you had bought these stocks on this stock tip, these stocks plummeted over the next 26 months, and you lost a massive amount of your wealth. But you might ask, hey, that's a few months. What happens if I held them for 10 years? Well, these 10 stocks collectively in this Fortune article over the next decade lost 47% of their value. It makes me wonder who holds them accountable for this sort of malpractice. Here's one of the stocks, Oracle. They said it had a target at the time of the article, the share price 72. They said it had a target of 115. And guess what? Oops, it missed the target. It did. The share price did not become 115. How about $10? And if you held it for 15 years, it became worth $39. Here's another one, CMGI. At $440 a share, they said it was a screaming buy. And if you would have bought it, you'd be screaming because it became worth 98 cents. And if you held it for 15 years, it became worth $3.43. How about Global Crossing? Analysts said it could triple in a year. Yeah, it could. And it could go to zero, too, and that's what it did. And how about WorldCom? At $45, the analysts proclaimed it's dirt cheap. But I don't know, you might be better off with the dirt. It went to zero. Dr. Charles Ellis from the Yale School of Management, who's an academic, has done a lot of studies on a lot of these professional stock pickers, and he studied many of them over many periods of time. And he said in a 12-month period, about 60% underperform, but if you lengthen the period, the failure rate increases. So when you go out 10 years, the failure rate increases to 70%. If you go out 20 years, you have an 80% chance with these sort of stock picking strategies to underperform. And I don't know about you, but most of our clients need to be successful investors over the next 20 years. And I just want you to ask yourself, if you want to underpin your strategy with an 80% chance of failure or chance of underperformance. So we've looked at long-term investing, but when you turn on the television, you open up the magazines, everything that I find, and you will find too, you just take a look at it, everything is pointed towards what's happening next, what's going to happen in the market in the next 12 minutes, or the next 12 months, the next 6 months. And I think we need to all become clear that in the short term, the future is very random and unpredictable, and that no one can predict it with any useful degree of value or consistency. When we're globally investing in the world, it means that we own asset categories in a lot of different countries. So we could have a year, for example, in 14, S&P had a pretty good return, 13.69. But I think that most people would have missed out if they just, got an E-Trade app and started trading. They likely missed out on equity rates of return that were on the table for the taking in countries where they might not have thought about placing their capital. So, for example, in Turkey or Israel or India or the Philippines or Indonesia or Egypt, these are all markets that dramatically outperformed the S&P during this period. Again, just to give you a look of what an engineered institutional model portfolio might look like, it might own as over 10,000 unique holdings in the portfolio at a given time. It might own 19, 20, 21 different asset categories that are correlated dissimilarly. That's a little, we'll get into that a little later, but also it could own 45 or more countries around the world. So I think there's this idea about single stocks that, if I get this stock and it goes through the roof, I could make a lot of money. And that's very true. I mean, here's an example of a great company that's made a lot of money for someone. If you had bought Amazon, we'll get to Exxon in a minute. But if you'd bought Amazon and held it for 2.5 years, I mean, who would not want their money to go up 172% in 2.5 years? That's an outstanding, fabulous, wonderful rate of return. Oftentimes people see this and they say, well, I want some of that, or I want the next thing that maybe is going to make me some money like that. Here's another example, Apple. I mean, oh my gosh, you'd be a multi-gazillionaire if you'd bought it way back. But, here's a hold period. If you bought it in January 1 of 13 and you went to March of 18, 5.2 years, here's a stock that went up 214%. That's a fabulous rate of return. That's growing your wealth very fast through a very good company. And who wouldn't want that? Here's another example of a good company where investors made a lot of money on the stock, Caterpillar. If I had owned it for this 9-year period, I would have had a 470% gain on my money. And yes, these single stocks can make you a lot of money. But there's many, many good companies out there. Take Coca-Cola, for example. It's a great global, worldwide company. But single stocks do things that really surprise and amaze people. Here's a company. If I had owned anything for 18 years, I think that using the rule of 72 and a conservative rate of return, it's a real long runway. It's enough time in a diversified portfolio to possibly triple my money. But what if I had just maybe pushed a lot of chips on this stock 18 years ago? I would have lost money. I wouldn't made any money, and then whatever money I had, it's depreciated by inflation. You need your money to double every 20 years anyway, just to keep up with inflation. So whatever I have now is worth about half, and this is what one single stock and one good company did to investors. How about Microsoft? That's another fabulous company. If I had owned Microsoft during this almost 17-year period, I actually lost money over a 17-year period. I don't think there's very many people that would imagine that could be a possibility with a great company like Microsoft. But these are the things that single stocks can do, the range of outcome that frankly most people have no idea of. How about this little company? Anybody ever hear of Walmart? Here's almost a 14-year period of owning. If I owned Walmart stock going back to 11 or 01 rather, during this 14-year period, 13.8 years, I didn't make any money, and I lost money in Walmart stock. Had I just decided that I like this company and I'm going to buy this stock. Here's a good one for you. I think a lot of people would argue that the Ford F-150 is the number one truck in the United States, and maybe it is. I think it's a great truck. I think Ford makes great cars. I think Ford's a great company. But here's a stock over 19 years, almost 2 decades, that over this span of time, the stock lost 67% of its value. And again, I think if I were to ask someone, if you buy that single stock, it might make you a lot of money, but I don't think most people understand what the downside is. If you've flown in an airplane lately, it may have had a GE engine on your airplane, and you may have GE appliances in your home. They own finance companies. They're the washers and dryers and refrigerators, and they're a ubiquitous, global, worldwide behemoth company with tens of thousands, I don't know, maybe hundreds of thousands of employees, and historically have been one of the stalwart, great behemoths of titans of industry. But over an 18-year period, until recently, their stock has lost 75% of its value. We could argue about why that is, but I'm highly confident that people buying GE stock 5-10 years ago would never have believed that is a possibility, especially for a great company like GE, what has been a great company like GE. Locally here, we like to talk about ExxonMobil, but in Cincinnati, where I travel sometimes for business, there's a big company there called Procter & Gamble. They don't make exotic things like software. They make diapers and soap, and probably 30% of the products that you buy at the grocery store are from a label that's behind the scenes owned by Procter & Gamble. Here's almost 10-year period where their stock lost 6.7%. And people that work at Procter & Gamble, many of them in the 90s some of them had all their wealth in Procter & Gamble stock, and when the stock tanked and stayed in the toilet for a long period of time, many of them were forced back to work. I told you that we would get to ExxonMobil, and here it is. I wrote an article recently about the great debacle of the lost decade of Exxon stock, where during a period of time, it actually lost value over a 10-year period of time. So many people at Exxon employs some of the brightest people on our planet, and many of them have pushed much of their wealth into this Exxon stock. I'm certain that most of them did not imagine that this was a possibility for a great company like ExxonMobil. And maybe you paid a terrible price for not knowing what the risk was with this company. And even the great oracle himself, Warren Buffett at Berkshire Hathaway, he's subject to periods of long periods of time when, this is actually a period of time when, plenty of stocks did well, but here's a 5-year period where his company lost money. How about Disney? It's another one of the companies I think of as a really good company in America. If I'd held this company 11.8 years, almost 12 years, I lost minus 7 point, almost 8% of my value is gone. I mean, I don't think people imagine that. You buy a stock and hold it for more than a decade and it loses money. So I have to ask you, with these range of outcomes that are out there with owning and picking individual stocks, how different is this really, and how would you describe it differently than speculating and gambling? And I want you to think about it. Do you want to speculate and gamble with your retirement money, or do you want it prudently invested, globally invested, and diversified? And if you're going to be a stock picker yourself, and if you're going to play the game and play the odds, is this what you want to do to occupy your time? I mean, some people do. That might be a perfectly valid activity for you. But when you're done with this presentation, at least you'll know what risk is associated that maybe you did not know before. Perhaps you're going to be that lucky one stock picker, that picks that, one. So there are people that win the lottery. And perhaps you could be that anointed lucky one. But when we look at the masses, and Dalbar researches every investor and equity investor in their comprehensive studies, quantitative analysis of investor behavior, and in the aggregate, these investors are doing poorly. They're investing in investments that have attractive long-term rates of return, but they are not earning attractive long-term rates of return, as evidenced by this study. And the study comes out every year, and every year we buy a new copy of it, and every year it says the same thing. When you buy individual stocks, you're saying, look, I don't want to settle, or I don't want to be satisfied for the rates of return that are on the table in certain asset categories that I could put in my portfolio. I want to forego that in lieu of the opportunity to make a killing. And I think what disciplined prudent diversification is bargaining away the chance to make a killing for the assurances that you won't get killed, for the assurances that you have a very high statistical likelihood approaching certainty of reaching all of your financial goals. Sometimes we might meet someone and they have a stock in their portfolio, and it may have a large capital gain. And maybe it's taxes that is causing the pause and the uncertainty. And they say, golly, I have this stock. I've owned it a long time. And if I sell it, it will trigger taxes. What should I do? Well, let's deconstruct this a little bit in this lesson. How about we tackle an extreme example? Like I had a stock and 50% of the value is gained. So maybe my basis was $50,000 and now it's $100,000. I've got a 50% gain. Let's apply a tax rate on a long-term capital gain of 15% and take a look at that. What's going to happen if I liquidate? Well, if I'm liquidating my entire position, I'm going to trade out of this single stock, which comes with a very wide range of possibilities, as we've seen previously. I'm going to create a 7.5% tax burden, am I not? So in thinking of that 7.5% tax burden, I would ask you to maybe try on a couple of different considerations. As number one, you're going to have to realize that gain at some point. That tax is not going away just because you kick the can down the road. And maybe you could say, well, I'm going to transfer it to my heirs, but I don't know too many people that have a significant amount of wealth, and I say, what is the purpose of this wealth? And they say, so I can just leave it to my heirs. That may or may not be the case for you. I'd say try on the idea that given the political climate, the tax rates may very well be higher in the future. Historically now, we are in some of the lowest, especially after this Trump tax plan, we're in some of the lowest tax rates in history. And you know what? Trump may do a term or two, but a new regime will come in at some time. And, I would submit for your consideration that you try on the idea of the possibility that tax rates are going to be higher in the future. If you look at any of the tax graphs, I think that would be a very plausible likelihood if you looked at that evidence. Now, let's say we're talking about a stock and it's equities. And I would say if you're devoting part of your investment capital to equities, you should have a 10-year time horizon for that anyway. So let's say you take a one-time tax bite or tax hurdle of 7.5%. If this is for an investment that's got a 10-year time horizon, let's spread it out and let's look at it. It's going to be equal to 0.75% annual return per year over 10 years. And that's how we get to our 7.5%. And ignoring the downside risk of one stock, plus the risk of missing bigger, winners that maybe you didn't own because you just had one stock or a few stocks, just diversifying into premiums, that should easily make up the difference. And so far, I'm just talking about opportunity cost. You're missing out on other things that you could have owned because you're kind of, pigeonholed or stuck in this one stock. Now let's look at what the real risk is. There's a great study out there called the Capital Distribution by Longboard Asset Management. And interesting enough, they were able to acquire data from the Center for Research and Security Pricing at the University of Chicago that went all the way back to 83. And they put this study together, and I found it fascinating, and I'm delighted to be able to share it with you today. In the study, they found that this 24-year period of time that they studied, the Russell 3000 had an aggregated average rate of return of 12.78. And if I had $1 in the Russell 3000, where I do not need any stock picks, market timing, track record investing, I don't really need any of those various ways to grow wealth. During that time, if I used a strategy like this, my $1 grew to $17.94. But here's the kicker. During that same period, 39% of the stocks in the Russell 3000, they lost money during that time period. They didn't make those great returns. In fact, almost 20% of the stocks that lost money had a drawdown, aka drawdown of 75%. 73% of the stocks that lost money had a drawdown or loss of at least 50%. And 64% of the stocks in the Russell 3000 that had a fabulous rate of return of over 12% during that period, 64% of those stocks in the Russell 3000 underperformed the Russell 3000. So by now, I'm hope that these pieces are coming together in your head. I think this was staggering for me personally to learn that in the Russell 3000 during this period of time, 25% of the stocks were only 1 in 4. 25% of the stocks were responsible for all of the gains. There's another more robust study out there from a professor at ASU. And this study used even more data. It was titled, "Do Stocks Outperform Treasury Bills?" Well, if somebody asked me, I'd say absolutely. I think we all automatically assume, maybe, as we should, that stocks outperform Treasury bills. It just depends on how you're investing in those stocks. More robust in this study because a much larger data sampling, and they looked at every month of stock returns going back to 1926 all the way to 2015. During this period of time, there were almost 26,000 stocks that existed at some point, and every stock had monthly returns. And if you multiply by the 26,000 stocks by the 12 months in a year and the period of time in the study going back to 1926, that's over 3 million monthly returns. The median in the middle, the median lifetime return of all the stocks in this study was negative 3.6, because take into consideration all of the companies that came and left and went out of business, and the fact that only the returns in these broad asset categories only come from a small percentage of the stocks anyway. So if you go down and you break down the data a little bit and you adjust for only time periods in which these stocks existed, only about 3 out of 10, only 30.6% of stocks outperformed a cap-weighted index of all stocks, meaning that you had a less than 1 in 3 chance of outperforming. Here's another great piece of information from this study, and it talks about during this period of time in the study, $32 trillion in wealth that was created, and only 86 of the 26,000 companies are responsible for 50% of it. And hence the name of the study. Only 58% of all stock, or not only, 58% of all stocks have produced a return less than that of T-bills over their entire lifetime. What I would almost pray that you're starting to take away from this is that non-diversified stock portfolios, going out and picking a handful of stocks based on some news article, they're subject, when you do that, you're subject to the risk that you're going to own the relatively few stocks that are actually going to post the large cumulative returns. The summary of this report says if you want to be a stock picker, you had better be a truly exceptional one, because the alternative is not pleasant. Statistically, you are, in other words, more likely to buy a stock which underperforms T-bills over its entire publicly traded lifetime than one which beats T-bills. And for the amount of risk that one would be taking on, I would just say, I would add, why would you do that? It's a crime against self. The only way I can think of someone doing that is they have no concept of what risk or what outcome is associated with such a activity or behavior. I think the investment firms out there, they make money off you buying and selling and trading. So whatever happens to you, that's just what happens. But I think what makes us a little different, we actually care what happens. I mean, we care about your American dream and what your outcome is, and care enough to pour into you with this sort of information so that hopefully you'll make wise decisions with your money as an investor. And at least we can know that we did our part to help put the knowledge and information in front of you. I would add that in my life experience, I think the rules of investing are simple, but they're hard for people to follow. People get distracted. You know what? You're going to see somebody that works next to you that maybe bought a stock and got lucky, and you're going to go, golly, I'm just getting these, conservative or average, single digit rates of return, whatever it might be. And my buddy just, he doubled his money. And there are people that are going to have experiences like that. There's people that are going to go to Vegas and come back on the airplane a winner. But I'm here to tell you that when the plane lands in Houston from Las Vegas, and assuming that it's full of people that were gambling at the casino, that plane is mostly full of losers. I'm highly confident in that. So if you're doing this on your own, or you're someone that we've shared this with, and you're just starting to figure out how things work and what you're going to put your faith and trust in, I would submit for your consideration these 7 core tenets of investing success. And if you're a client of Provident Wealth Advisors, you already know and understand you're set up this way. But we believe that portfolios constructed with rules and formulas versus winging it, speculating, gambling, that you're going to have a much better outcome. We believe that the statistics suggest that over long periods of time that you'll come out ahead using rules and formulas. We believe that asset allocation, diversification, correlating your asset classes in dissimilar movement, rebalancing, risk adjustment, that these are the things that should go into any well-conceived retirement plan and or portfolio. We believe, and good research shows, that equities handled the right way pay much greater premiums to investors than fixed income over time. We believe that value stocks, because of the numerous empirical studies that actually prove this, but value stocks have historically paid greater premiums to investors than growth stocks over time. And small stocks pay greater premiums to investors than large stocks over time. We believe that low-cost solutions are preferable to high-cost solutions when all things are equal. We also believe that investor behavior is the dominant determinant of investor performance. I mean, we could help you build the most immaculate portfolio in the world, and you could own it for 6 months, and the waters get a little choppy, and you panic out and sell and move to cash. Anyone can destroy a well-conceived investment plan, process, and portfolio with behavior. I'd like you to try that idea on and to take it seriously. John Bogle, the founder of Vanguard, is quoted as saying, "The emotions of investing have destroyed far more potential investment returns than the economics of investing ever have." Another way of saying that is the investor is his own worst enemy much of the time. And I think most of that people look at that and they go, "That's other people." And no, it's not other people. It's you and me, because we're creatures, we're human, and creatures of instincts and emotions, which are great to have instincts and emotions, but they don't always serve us the best way with our money. And we would submit for your consideration that you look rather at a process and rules and formulas as a philosophy as far as how to invest your money. So in bringing this together and wrapping this up, I would just merely ask you, what is the cost of the big mistake for you? What happens if you work 20, 30, 40 years and you kind of blow it there, or you make some bad decisions? What happens if you make the big mistake? What's at risk? What do you have at stake in all of this? Is it your money? Is it your savings? Is it your peace of mind? Is it financial security? Is it the ability to live an abundant and impactful life? Quality of time with your friends and family? So I just ask you to think about that, and maybe think about what you want to put your faith and trust in. I'm honored to be your coach. I'm honored to be your friend if we're working together. And I'm honored that you've taken your time, your important and valuable time, to listen, to watch, to learn, to study, to advance your own knowledge and understanding and fiscal literacy. I'd ask you to look around you and look at the people that you love, and consider, some of your friends and family are not going to make it 3/4 of Americans are nowhere near on track. And I would just ask you to think about that, because once we have things buttoned down for ourselves and we have a plan and a process and a philosophy and a strategy, and once we're doing pretty well for ourselves, I think we need to look at our fellow man and our friends and neighbors and our loved ones, and maybe we need to help them along or point them towards some useful, helpful information to help them grow and protect their wealth. So I hope you had some good takeaways from here. I just really appreciate it when people send me any feedback or comments. I don't, it's good or bad. You may want to send me an email and say, hey, you know what, this is worst presentation I've ever seen in my life. I would just appreciate, I appreciate if whatever the feedback is. We have a great research team. I want to thank the other 400 coaches that I am in association with at our team here at Provident, the research that goes into these sorts of presentations, and quarterly, every 90 days, we're going to send you a new module, learning lesson on a variety of different topics. So when they come, actually take it serious. Take a few minutes of your time. Do it over coffee in the morning or a glass of wine in the evening, or when you have some quiet time, turn on your computer, your speakers, plug in to the Provident Fiscal Literacy Academy, sharpen the saw, share the knowledge, wisdom, understanding with your friends, and we're committed here. All of our team is committed to your long-term success. So I look forward to speaking to each and every one of you, and thank you again so much for tuning in. I'm Coach Dan.